Be Wealthy and Smart, episode 859.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, I want to share a story with you about Archegos Capital. This is a hedge fund that got into financial trouble due to too much leverage. We're talking 500% leverage, and how it started to impact other investment banks, financial companies, media companies, and it's a very fascinating story. If you haven't heard about this, this is the biggest news in financial markets. So this article comes to us from Bloomberg, published on the Straits Times. And it says, for Archegos' Bill Hwang, one of the world's greatest hidden fortunes is wiped out in days. From his perch high above Midtown Manhattan, just across from Carnegie Hall, Mr. Bill Hwang, it's spelled H-W-A-N-G, was quietly building one of the world's greatest fortunes. Even on Wall Street, few ever noticed him until suddenly everyone did. Mr. Hwang and his private investment firm, Archegos Capital Management, are now at the center of one of the biggest margin calls of all time, a multi-billion-dollar fiasco involving secretive market bets that were dangerously leveraged and unwound in a blink. Mr. Hwang's most recent ascent can be pieced together from stocks dumped by banks in recent days: Viacom CBS, Discovery, GSX Tech EDU, Baidu, all of which had soared this year, sometimes confounding traders who couldn't fathom why. One part of Mr. Hwang's portfolio, which has been traded in blocks since last Friday, March 26th, by Goldman Sachs Group, Morgan Stanley, and Wells Fargo and Company, was worth almost $40 billion last week. Bankers reckon that Archegos' net capital, essentially Mr. Hwang's wealth, had reached north of $10 billion. And as disposals kept emerging, estimates of his firm's total positions kept climbing. Tens of billions, US $50 billion, even more than US $100 billion. It evaporated in mere days. I've never seen anything like this. How quiet it was, how concentrated, and how fast it disappeared, said Mr. Mike Novogratz, a career macro investor and former partner at Goldman Sachs, who's been trading since 1994. This has to be one of the single greatest losses of personal wealth in history. Late Monday in New York, Archegos broke days of silence on the episode. This is a challenging time for the family office of Archegos Capital Management, our partners and employees, Ms. Karen Kessler, a spokesman for the firm, said in an emailed statement. All plans are being discussed as Mr. Hwang and the team determine the best path forward. The cascade of trading losses has reverberated from New York to Zurich to Tokyo and beyond, and leaves myriad unanswered questions, including the big one. How could someone take such big risks, facilitated by so many banks, under the noses of regulators the world over? One part of the answer is that Mr. Hwang set up as a family office with limited oversight and then employed financial derivatives to amass big stakes in companies without ever having to disclose them. Another part is that global banks embraced him as a lucrative customer, despite a record of insider trading and attempted market manipulation that drove him out of the hedge fund business a decade ago. A disciple of hedge fund legend Julian Robertson, Mr. Bill Hwang shuttered Tiger Asia Management and Tiger Asia Partners after settling an SEC civil lawsuit in 2012, accusing them of insider trading and manipulating Chinese bank stocks. Mr. Hwang and the firms paid $44 million, and he agreed to be barred from the investment advisory industry. He soon opened Archegos, Greek for one who leads the way, and structured it as a family office. Family offices that exclusively manage one fortune are generally exempt from registering as investment advisors with the U.S. Securities and Exchange Commission. So they don't have to disclose their owners, executives, or how much they manage. Rules designed to protect outsiders who invest in a fund. That approach makes sense for small family offices, but if they swell to the size of a hedge fund whale, they can still pose risks, this time to outsiders in the broader market. This does raise questions about the regulation of family offices once again, said Tiger Gelash, a former SEC aide who now runs the Healthy Markets Trade Group. The question is, if it's just friends and family, why do we care? The answer is that they can have a significant market impact, and the SEC's regulatory regime, even after Frank Dodd, doesn't clearly reflect that. Archegos established trading partnerships with firms including Nomura Holdings, Morgan Stanley, Deutsche Bank, and Credit Suisse Group. For a time after the SEC case, Goldman refused to do business with him on compliance grounds, but relented as rivals profited by meeting his needs. The full picture of his holdings is still emerging, and it's not clear what positions derailed or what hedges he had set up. One reason that Mr. Huang never filed a 13F report of his holdings, which every investment manager holding more than $100 million in U.S. equities must fill out at the end of each quarter, is because he appears to have structured his trades using total return swaps, essentially putting the positions on the bank's balance sheets. Swaps also enable investors to add a lot of leverage to a portfolio. Morgan Stanley and Goldman Sachs, for instance, are listed as the largest holders of GSX Tech EDU, a Chinese online tutoring company that's been reportedly targeted by short sellers. Banks may own shares for a variety of reasons that include hedging swap exposures from trades with their customers. Goldman increased its position 54% in January, according to regulatory filings. Overall, banks reported holding at least 68% of GSX's outstanding shares, according to a Bloomberg analysis of filings. Banks held at least 40% of Iqiyi, a Chinese video entertainment company, and 29% of Viacom CBS, all of which Archegos had a big bet on. I'm sure there are a number of really unhappy investors who have bought those names over the past couple of weeks and now regret it. Mr. Doug Sifu, Chief Executive Officer of electronic trading firm Virtu Financial, said on Monday in an interview on Bloomberg TV. He predicted that regulators will examine whether there should be more transparency and disclosure by a family office. Without the need to market his fund to external investors, Mr. Huang's strategies and performance remained secret from the outside world. Even as his fortune swelled, the 50-something kept to a low profile. Despite once working for Mr. Robertson's Tiger Management, he wasn't well known on Wall Street or in New York social circles. Mr. Huang is a trustee of the Fuller Theology Seminary and co-founder of the Grace and Mercy Foundation, whose mission is to serve the poor and oppressed. The foundation had assets approaching $500 million at the end of 2018, according to its latest filing. His extraordinary run of fortune turned early last week as Viacom CBS announced a secondary offering of its shares. Its stock price plunged 9% the next day. The value of other securities believed to be in Archegos' portfolio, based on the positions that were block traded, followed. By Thursday's close, the value of the portfolio fell 27%, more than enough to wipe out the equity of an investor who market participants estimate was 6 to 8 times leveraged. You have to wonder who else is out there with one of these invisible fortunes, said Mr. Novogratz. The psychology of all that leverage with no risk management, it's almost nihilism. End of article. Well, this is so interesting because this loss that Archegos Capital is experiencing has spread to other banks. And the banks have lost lots of money, namely Credit Suisse, Nomura Securities, and Deutsche Bank has also reported that it has exposure to the hedge fund and has experienced a significant loss, the size of which it has not yet specified. Morgan Stanley and Goldman Sachs also liquidated stocks due to their exposure to the hedge fund, and it remains to be seen if anyone else is involved. But I suspect we may hear of some ripples through the market that this has impacted other funds, managers, or banks. So we'll continue to follow this story and see if the exposure to these losses continue to spread. But this is something that is not that different from long-term capital management or from Lehman Brothers. Some other situations we've seen where a lot of leverage was used, the market went the other way, big losses were experienced, and it took a lot to unwind those trades, impacting a lot of firms in financial markets. So we'll follow this. I wanted to share this article with you because I think this is the single biggest story going on right now in financial markets. Whether you're hearing about it or not on the television, this is what is going on behind the scenes and what every single financial firm is talking about right now. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all of my podcasts are listed on my website at lindapjones.com/podcasts. In your Apple podcast, only a fraction of my episodes are there. All of them, however, are on my website. So check that out as we're coming up on our 7th year anniversary of Be Wealthy and Smart. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.